when you start putting a larger project together, people will ask to see your finance plan. There's a template on Screen Australia, which is a draft finance plan, and it basically splits the finance plan up into marketplace attachments and equity attachments. Marketplace attachments are basically things like advances from sales agents, advances from distributors, things like that. And they're basically, they're really loans. Somebody is loaning the production money, and they will get repaid. Say, for example, a sales agent will take the money for their loan when they start selling the project, and they'll keep that money to repay the money they've lent. So you get marketplace attachments, which are basically loans. You then get all your investments, which is all the investment you're getting maybe from Screen Australia, maybe from private investors, maybe from your producing director who are investing into the project, things like that. A loan is basically somebody is giving you money, you have to repay them that money. There may be interest on the loan. So for example, somebody's cash flowing the producer's offset, they'll charge you interest. If your dad's putting money in, he probably won't charge you interest. And basically you have to repay that loan, maybe with some interest, and then that's it. Once you've repaid the loan, you don't owe them anything else. Whereas an investment, somebody's basically going, I'm going to give you money and I want a share of the future profit of the film. So if this film makes money, I will get a share of profit based on, okay, this $1 million gives me, 50% of the equity. So I will get 50% of the profit coming back to the investors. So basically it has a profit share, future profit share. So if the film does really, really, really well, that investor should do really, really well. Whereas for a loan, once they're repaid, that's it, they're out. You don't need to, they're not involved with any money coming in. So it really is investment. They've got an equity share. They've got a right to future profit. Loan, they just need to be repaid. They don't have a share in future profit. And then you also get your grants, which go into the equity section as producer equity. So the whole thing is, you put together your finance plan. It's got to match your budget, which is the A to Z budget, which I was going to talk about in a minute. And there is a grant called PEP, the Producers Equity Program. If you're a documentary between 100,000 and 500,000, it's definitely worth chatting to Screen Australia to see if you qualify for the Producers Equity Program. It's 20%. They'll give it to you at any time. You don't have to finish your film. So you can go in and say, here's my project. I'm spending, 200,000, and if you qualify and do, that, then they can give you 40,000, even before you start shooting. So if you're a documentary in that range, definitely worth speaking to Screen Australia about PEP. There are also some posts. Basically, if you go out and shoot your film and you don't have enough money to finish, you can sort of take what you've got into Screen Australia and go, here's a great film. It's a lesbian romance comedy, which is what I worked on. And they go, yeah, we love it. And we'll give you 70 grand to finish the film. So there are post-production grants you can get from Screen Australia. You're normally going to have a chunk in there for your producer's offset. So you're going to get money for your producer's offset. Normally when you're starting a project, you can, you might know you're going to get some money out of Screen Australia or Screen New South Wales. And quite often when you're doing you might have chats with the distributor, and the distributor will say, yes, if that project gets greenlit, I'm good for this amount, and you start negotiating agreements. Quite often with finance plans, you can actually pull together 70 to 80, 85% of a finance plan, with a fair bit of work. And it's quite often that last 10 or 15%, which is why people will often talk about gap financing, which is, gap financing is very expensive, but basically, like if you're 90% financed on a $10 million project, you might be willing to pay somebody 20% on that final $1 million to get them in and get the project up and running. So quite often with new people, I spend a bit of time going through what a finance plan is, how to put it together, and people come in with finance plans. I go, oh, okay, no, is that a loan or equity? Oh, it's money I got off my dad. It's like, great. Is he expecting the money back, or is he expecting a share of profit? So the basic difference is, if somebody is just going to get repaid the amount they've given you, and maybe some interest, and that's it. It's generally a loan. If somebody's going to get a share of profit moving forward, so if the project blows up, they do really well. And if the project doesn't blow up, they're probably not going to get their money back. Then that's generally equity. When you're doing a finance claim, you also need to be thinking of something called the waterfall. I haven't mentioned it here, but basically when money comes back in from selling the project, you've got to have a waterfall, which is, okay, the money comes back, who do we owe money to? Like, let's say you've still got some creditors for the film. You might still owe the gaffer or the grip some money. So you've got to pay all the debts to the film initially. When all the debts to the film are paid off, and any loans you've got to pay off, if you're taking producer's offset loan, then basically the investors then get their capital repaid. So this is, let's say, your dad's put $1 million in as an investor. You can then repay him that $1 million. And when that money goes back to him, it's tax-free because it's repaying his capital. And so that's also a useful thing when, from a tax point of view, you can start repaying capital to investors. When you've repaid all your capital, your project then goes into profit. And generally what happens is when you're in a profit, 50% of the profit will go to the producer and 50% will go back to the investors. So that you actually start share once you've hit profit and repaid all your capital. And let's be honest, a lot of projects don't get into profit, but when you do, you then got that profit share where the producer is getting 50% of the profit and the investors, the equity investors, are getting 50%. Now this is where it's interesting, because if it's a producer's offset project, the producer's got maybe 40% of the equity because of the producer's offset. So in fact, the producer can be in a situation where they're getting 50% of the profit as producer and another 20% of the profit as the investor through the producer's offset. So the producer can actually be in a great position in a project if and when it starts generating profit. So that's one of the interesting by-blows of the producer offset. There are about 20 people who lend against the cash flow. There's a list on the Screen Australia website, so you can speak to all of them. Some of them work in different parts of the market. I quite often work with the same 2 or 3 cash flow people because I work very much at the independent end of the market. If you're starting out, you need to familiarize yourself with the A to Z budget. It's basically the industry accepted format for budgeting. So after you've got your script, people go, have you got your budget? And they'll generally expect to see it in the A to Z format. 95% of them are in the A to Z format. Some people use Movie Magic or Studio or something, but generally, and it's like 1,600 lines long, of which probably about 1,200 will not apply to your production. So you actually only use about a quarter of it, but you've got to go through and say, and generally if you're putting together a budget, you generally be speaking to a line producer or a first AD or a production manager and stuff like that to put it together.